If you look at the Indian markets in the current context, the micro situation hasn't been great in that the earnings growth over the last 5 years has been around 7%, but the macro situation has actually improved for the better. So, if you look at the deficit numbers, if you look at where inflation is today, clearly I think things have improved. The new government that has come in has done a few things in terms of improving the ease of doing business, in terms of getting better transparencies in natural resources allocation. The thing is, this is a large economy, and when things go slow, to put it back on rails takes longer. So that's why you're seeing the actions taken by the government is still not reflected in terms of numbers. My view is that over the next few quarters, one would start seeing the earnings growth numbers improving from a 7% CAGR that we have seen over the last 5 years. I would think that over the next couple of years, one should get back to the 10-12% kind of growth levels. So our expectation for the Indian market, hasn't been achhe din as people had thought. But I guess if earnings growth comes back into the system, one would see markets recovering from here, given the fact that we've had a bad year last year, and that was for a fact that we didn't have earnings growth come through. So once you see that earnings growth number start showing up, you will see markets doing much better from here on. If you look at history over longer time frames, whether you take time frames of 5 years, or 10 years, or 15 years, or 20 years, generally markets have given returns much better than every other asset class. If you look at the last 35 years data of the stock markets, we've seen a compounded return of around 15% for the markets, which has generally been in line with the kind of earnings growth that the market has seen from corporate India during the same time frame. So our reading is, if one stays sufficiently long in the markets, one would try and track the kind of returns that earnings show. As regards to whether an investor should look at investing in an SIP route or the lump sum route, lump sum should generally be made when you see strong corrections in the market. I think that should be used as a good entry point should market sell off for reasons which are beyond reasons of fundamentals. So if you see some foreigners selling in the market and the markets correct sharply, it's not that the fundamentals have changed. That should be used as an opportunity to buy into the market using the lump sum route. So one should continue doing SIP through ups and downs of the market, and top it up with lump sum investment as and when they see opportunities that the market presents because of extraneous reasons. It could be because of a sell off or for reasons which are not impacting the fundamentals of corporate India as well as the economy at large.